My G's, welcome back, baby, to the Fomc episode 7 of the live trading stream, the Fomc Gold and the NQ volume plus Orderflow profile. We're gonna absolutely crush it today. I hope you guys are doing well. Let me know if you guys are in the building here, if you guys can hear me. Before we put on some nice, fresh tunes and get the party started, okay? I'm back home. We're going to make it an amazing stream here. We're going to talk about Uncle Jerome. You guys know it. Uncle Jerome, my favorite uncle. Yes. I hope you guys understand. We're going to watch the Jerome Powell or the live trading FOMC stream today. 2 a.m. for me, G's. 2 a.m. for me. Just came back from Malaysia. I just arrived in the evening here. Couple hours and back to the streams. So I'm looking forward to go over it here. Type in a 1 in the chat. If you guys can hear me correctly, let me know. Type in a 1 in the chat so I know everything is working correctly. And then I think we should get the party started there. Yes, 2 a.m. for me. Late night. But I couldn't be here without you guys, of course, every day. As I promised for you guys here, we have the FOMC stream today. So we're going to talk about the FOMC statement, the press conference. What is Uncle Jerome going to tell us today? But before we go, of course, we have to put it off strong here. Let me see what we have with us in the chat before we move forward here. Okay. My man, William. Good to see you, my G. Saeed, welcome back. Yes, sir. Emperor, Jam, A. Chu. Yes, good to see you, Korean Reaper. Yes, sir, my man. There we go. Smash up that like button. All right, let's smash up that like button for the free fucking education. Freaking education, sorry. And let's get the party started. I have a song for you guys. Let's kick off the stream strong. Yeah? Okay. There we go. Let's make it happen, man. Let's make it absolutely happen today. There we go. Let me see if we can get it down here. Let me see if you guys can hear me correctly. Welcome back, baby. Yes, sir.
Let me know. Put you down for the vibe. Are you down for the vibe? Oh, we don't say bye-bye. You can see my eye, and I'm on the run. Oh, I believe body lies.
Love you guys. Love you guys. Love you guys. Ladies and gentlemen, welcome back to the live stream. FOMC. Uncle Jerome is going to speak in around 30 minutes from now. We just had the news here. Let's go. Let's see where it takes us here. All right. You guys are the freaking best. I'm telling you, you guys are the freaking best. We're going to get into the news right now. You all know that it will be 3.75%. That's no surprise. That is no surprise. 3.75% is exactly what we expected, okay? But that doesn't really matter for the stream, okay? The expectation of the interest rate decision is not really what we care about. I'm just going to tell it already, right? The PPI was not really that great here, but the FOMC interest rate decision was 3.75%. We already knew it's not going to be a big deal, okay? So we're not going to look at the interest rate decision. We all know that that's not a big deal here. But what matters is the FOMC press conference, all right? The oil price and the potential inflation and his opinion, Uncle Jerome's opinion about the inflation and about everything that's coming in regards to potential rate cuts, potential rate hikes, whatever he's going to say. We have to listen to what Uncle Jerome says because this is going to have an impact on the dollar and on gold for the near future. So that is the whole incentive for this stream today, is to get an understanding of what he is going to say in around, quote unquote, 30 minutes from now. I hope you guys are ready here. We're going to do our gold analysis. We're going to go over it. We're going to go over the dollar. We're going to look at the dollar on the higher time frame and the lower time frame. We're going to see what's going on here. And then we're going to move to, of course, the press conference to see what Jerome has to say. And then we know what to do for the next coming days, weeks ahead of us here. Does that make sense here? Press a yes in the chat if you do. And smash up the like button here. We have our free education here. We just want to make sure that you guys are updated on every live stream. We're going to be back tomorrow again. All right, tomorrow at 8 a.m. EST, we'll be back for a New York trading session. Let's get that news behind us here. Let's get everything behind us and let's move on to the actual price action after that. So we can actually, trade normally, stream normally like we usually do. But we have to deal with this shit, okay? We have to deal with all this important data and news in order to get a good understanding of what we are looking for. I hope that makes sense, all right? So, fantastic. If that makes sense, let's move forward. Good to see you, Maria. An absolute pleasure to host you as always. Thank you for being here for a couple years already. I really appreciate you. Kelvin, you too, my man. Jackson, Aquila Trader, Thomas, Xavier, yes, Dominic, Cowboy. Cowboy says the PP is not good. Uncle Jay will say we need more data and rates stay the same longer. I would actually not be surprised if that's the case here. I completely agree. Tony, good to see you. Jackson, good to see you, my friend. Absolutely amazing to have you guys here once again here. I'm just a random guy here trying to give you guys some insights in regards to what we're doing. I'm trying to be as profitable as I can be like you guys. I'm trying to trade gold like you guys. I'm trying to make some money like you guys. Okay? Let's get started. Incredible stuff. All right. Without further ado here, let's move on. And let's go over some data. I think it's super important to see what gold has been doing here because you can probably see what happened today. Okay? And I'm not sure if you guys were on yesterday's stream, where we talked about quote unquote gold when we were looking at a ranging market where not really something was happening here. And when we were looking for a little, kind of a little pullback, somewhat in that range. But today, very intriguing, right? We broke out of that range, right? Price came down, it broke down aggressively. And you could see that gold actually dropped around 3.5%. That's a big move for gold here, okay? So we came from an extremely overvalued scenario where we actually dropped really hard. And again, we talked about this overvaluation all the time, right? Against the dollar. And look at where we came from. We finally became overvalued. And look at what happened, right? We created the top, and after that overvaluation, we dropped really freaking hard, and we dropped all the way down, and we actually kept dropping lower and lower and lower. So we always have to understand it in the right context. the valuation matters, right? In the right context, okay? So anyways, from now on, we are looking at what? An overvaluation against the dollar here. And look at what gold is doing here. So if you're trying to buy the pullback, okay, I'm just saying, if you're trying to buy the pullback right now, be very, 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 very careful, because this is where people get trapped, okay? People buy at these pullbacks and then they think, okay, this is the perfect moment to buy. And then gold does what? It keeps going lower, okay? So right now, let's talk about the data. And let's talk about the actual outcome of the interest rate decision here. The forecast of 3.75% of how it actually is going to be 3.75% right now. But I don't really truly believe that this interest rate decision is what truly matters. Okay? I think what matters is the press conference is around 25 minutes. Okay? So this is what we're going to listen to. We're going to listen to Uncle Jerome. And we're going to see what he has to say here. I listened to some other guys here, Stock Sniper Trading. I think he has been killing it lately as well here around gold. So I want to give some shout outs to some other streamers, because I think some guys have been really crushing it while I have been away here. And this guy has been really doing its thing. So I really appreciate that. I really think that he has some good stuff as well. So if you're interested, though, watch his stream as well here, because I do think he has some good things to share. But anyways, let's go over the markets and let's look at the dollar. And let's look at gold, okay? But before we go into the order flow of things here, because the order flow is right around there, we're gonna look a little bit deeper into the current situation, because gold right now has been dropping really hard. And I must say, with an objective opinion, that what I'm seeing right now in gold is not really looking that great, okay? And the reason why I'm saying this is because of the following. And it's very unfortunate, but it's the situation is that we're constantly creating new freaking supply zones, okay? So if you guys know supply and demand, and you guys have been trying out supply and demand here, there are a couple of things that work in the markets on the higher time frame, and I've been testing this out for the past, I don't know how many years, and that is the supply and demand dynamics, okay? When our sellers in control of the price action, and when our buyers in control of the price action, and we can actually clearly see that right now sellers are definitely in control here. So when we talk about the fundamental side of things, we all know and we can all agree that the fundamentals scream bullish. But if the technicals do not align, guys, then it's really hard to be bullish on gold, okay? And this is currently what we're seeing here. So with that said, all right, we had that major push up here. We got that major drop. We couldn't re-break the highs. We got rejected at an area of supply. So we have a daily supply zone right here, okay? And the moment we got rejected at the supply zone, we created what? We created another supply zone right around there, okay? The same concept. We have a bullish candle, we have an indecisive candle, and then we have a major drop, okay? That signifies that the indecisive candle might be the candle where we find supply, okay? So we have this supply zone. We got rejected there, okay? So what happened when we tapped into that supply zone? We created a bullish candle, we created an indecisive candle, and we dropped. So we mark out this as an area of supply. Then we have another one right here, a bullish candle, an indecisive candle, and then a major drop. So we have another supply zone right here. And guess what we're seeing right now? A bullish doji, a indecisive doji, right? Bearish, and a major drop. So if this candle closes bearish once again, and we do not see a major, reversal, okay? Then you guys can clearly see that this will also turn into an area of supply here. So right now, sellers are in control. We cannot deny this here, but the positive side of gold today is that we do not have a daily closure yet, all right? The daily candle closes in around 2 hours and 50 minutes, okay? I just want to be clear on that. 2 hours and 50 minutes. So that means that as long as this candle is not closed yet, that we don't know what's going to happen yet, okay? So if the press conference comes out and Jerome Powell is talking about the dollar and everything is fine, the dollar might pull back and gold might push up again. So we don't know exactly where this daily candle will close here. But what I want to say is that if this daily candle closes bearish, below the previous low, we will have a new daily area of supply, and this will act as resistance right there. So this is something that we do have to take in consideration. A lot of resistance, a lot of sellers are in control here at this current moment. So we have to be a bit cautious from that standpoint here if you guys are trying to buy gold, okay? Just want to make sure that you guys understand this, because overall, I get it. The trend is bullish, but right now we are seeing that more and more sellers are starting to creep in. I don't like it. I want gold to go up, but we have to wait this daily closure in order to really understand what is going on here. Okay, I hope that makes sense. All right, so anyways, let me know in the chat what you guys' biases right now around gold here. I'm also very, very curious. But we're going to talk about this, and we're going to listen to Uncle Jerome live, and we're going to go to the lower time frame, and we're going to see if there actually are still some trading opportunities right now around gold here, okay? And the main thing that you guys know is I use the volume profile, I use the valuation tool, and I use some order flow to determine if gold might push down or push up further. We're going to make sure, but I really want to know what you guys are thinking about gold right now at this current moment, because it's getting at a very, very interesting stage here, okay? That is gold in the higher time frame. Supply is definitely in control here. So let's go to the hourly time frame right now on gold here. You can see that we had that major sell-off, but we did find an undervaluation. So we are seeing kind of the bottom getting formed here. But we are definitely sure that buyers are not in control at this current moment, okay? We just have to acknowledge this. I want gold to go up, but you know, there's something about price action that you just cannot deny. All right, and that is that we can just simply see that price is just continuing to drop lower and lower. Okay, now from the dollar standpoint right here, okay, the dollar has been actually super aggressive and has been coming up since January. Pretty much the whole month of February and March has been bullish. However, right now you can see that after we took out these highs and we tapped into this daily supply zone right here, so you could see it. We talked about it yesterday already. We took out these highs, and we are now flipping bearish. You can kind of see that the dollar is now trying to find its support. But at the same time, the good thing is for gold is that that gap that we talked about yesterday, right below here, is not filled yet. Okay, so that gap is still there. So I would not be surprised if the dollar potentially would tap into that eventually. But we kind of are finding support at this current moment here. So when looking at the lower time frame here, let's go to the 50-minute on gold here. Okay, we are looking at overvaluation, and you can kind of see right now that gold is overvalued. So buying here is definitely an option for us. Okay, the only reason for gold to potentially find a bottom here is if you to come down all the way towards the lows and actually find some freaking support again. Okay. Tech Gamer Boy says gold definitely looks weak. I agree with you. Ahmad says, why did you stream the opening? Well, to be honest, my friend, I was just traveling all day. Okay, I came back around the New York Open. So I just flew back from Kuala Lumpur to Bali. And I just literally arrived here and got some things done. And now I'm here back on the streams for you guys for the actual FOMC. Okay, so yeah, better an FOMC stream than no stream at all. I think that's the bigger deal. Okay. Julian says oil is driving the market more than the dollar. Yeah, I agree with you. But keep in mind that oil and the dollar are heavily correlated at this current moment. Okay. If you look at the oil here and we open the dollar, it's pretty freaking similar to me. Okay, I'm just saying. It's pretty similar. If you look at the price action overall, it's really freaking similar. Okay. Absolutely. Anyways, we have around 15 minutes left. We are gonna watch the Jerome Powell speech. Let me know if I can actually find it. Let me quickly see if I can find the stream already. So if this set up here, and that should do the job. Let me see here. Crazy how the market dumped before the POI and the FOMC news. This is, I agree completely, my friend. This is absolutely crazy. We saw a huge drop. I don't know how many points is it. How many pips is this actually on gold? Let me actually see this. But I think it's massive. Let me see. Yeah, look at that. Around, holy moly, man. 1,700 pips to the downside, okay, before the FOMC. Yeah, this is a major sell-off. And the problem was that I saw dollar selling off, I saw oil selling off, I saw gold selling off, I saw everything pretty much selling off, including the Nasdaq. pretty much everything, right? And yesterday we talked about it in regards to the Nasdaq. We talked about the Nasdaq pushing up into that daily demand zone, taking out the previous daily highs, and then pretty much rolling over, right? And then just absolutely selling off right here. And this is exactly what we're seeing here. So after we took out the previous daily highs, we got to an overvaluation right around there. And that was the absolute freaking top. And we sold off right there. So the Nasdaq is looking weak. And this is why I believe that it's very hard right now to be bullish on gold, to be really honest with you, okay? It's very hard to be bullish on gold too, but we hope that Uncle Jerome will give us some insights into what's actually going on here. So anyways, we're going to be looking for Uncle Jerome. We're going to watch his press conference live. We're going to cover everything that he says. And if this is your first time joining, okay, I just want to make sure that you understand that the data that comes out when it comes down to the FOMC here is not per definition the most important information. I just really want you to understand this, okay? Because people think that, okay, we look at the interest rate decision, it's 3.75%, so that's pretty much it. It's usually not about the interest rate decision, because a lot of people that look at the interest rate decision already had this in mind here, okay? You can go to what we call the Fed moderator tool. So you can literally type this in on Google and go to the Fed moderator tool. You can click on it, and then you guys can already see that today it was a 99% chance, okay, that we would have expected the 3.75%. All right, just want to make sure that you understand this here. Somewhere between an 86% and a 99% chance that we would see that exact 3.75%. So this is not what people are looking for. Well, what people are looking for is what actually will happen in the near future, okay? So imagine this, okay? Imagine the fact that a lot of people will talk about the fact that we have the war with Iran right now, all right? And I just want to make sure that you understand this. This is going to have a major impact on the oil price. Like we have seen what has happened to oil over the last 2 weeks. So if oil keeps rising, this will have a negative impact on the inflation, okay, in the United States. So if this is going to be the core problem, a lot of people in the press conference will ask Jerome Powell about, what do you think about the oil price rising? What do you think about the current inflation? What do you think is the projection for inflation over the next coming weeks ahead of us or months ahead of us here? And that is the core problem for today. And that is what we want to listen to, okay? So if we can get any insights in what Jerome Powell has to say around the interest rate decision for the future, the inflation for now, and the oil prices and the expectation of the impact it has, that is something that we're looking for, okay? So this is going to be very important for us, not just for today's trading stream, but most importantly, for what will come over the next coming days or even weeks ahead of us here, okay? So this is the main reason why we're looking for a potential reaction from Jerome Powell around the actual scenario here. So we're going to wait patiently for what Uncle Jerome has to say. And then we're going to go into gold, and we're going to watch gold. We're going to watch the dollar. We're going to watch oil very, very shortly. And we're going to see what actually is happening from that standpoint right there. Okay? Tech Gamer says, crazy how it dumped. I agree. Markets were absolutely wild. Yes, I wish, to be honest with you, I wish I was there live before the stream as well, or before the actual FOMC here. I agree with you. Yes. Mario says, if Uncle mentions a rate hike because of oil sharply going up and jobs numbers not looking good, risk on assets could dump very hard. This is some of the things that we're worried about for gold, right? Because if they're indeed thinking about increasing interest rates, this is probably going to be one of the biggest problems right here. I do agree with you. Now, in terms of the order flow, right? If you look at the order flow right now, we can clearly see that a lot of sellers, and this is on a 15-minute time frame, a lot of sellers stepped in right around here, okay? We could also see that right in this candle, we see a negative delta of around 236 minus. That means that there were a lot more sellers than buyers. And if you see that within that candle, okay, within this 50-minute candle, which is actually this candle right here. Let me actually mark the supplies on the lower time frame, just so you have an understanding of it right here. Okay? Right there. You can actually confirm that a lot of selling took place right here. And look at how we're reacting from that same zone right around there. So let me actually mark this out perfectly. There we go. You can actually see that there are a lot of more sellers coming in right now. So we can clearly see that with that overvaluation, that right now, things are looking quite bearish, okay? So I just want to make sure that you guys are definitely seeing how bearish gold is at this current moment. But at the same time, trading gold right now, right before the FOMC press conference, is usually not the best thing to do. Okay, so this is the main reason why we're waiting for what's coming right now on the FOMC here, and to see what gold is actually doing here. But yeah, a lot of selling, clearly. Sellers are in control, there is no doubt. And I think that buying here is extremely tricky, okay? Trying to predict the bottom here is not per definition the best thing to do, because sellers are in control, we pull back, we're overvalued. And you can actually see that this was truly the last point of control, okay? Where sellers aggressively stepped in with a lot of volume. And you can definitely see that sellers are now in control right here at this current moment here. So we're going to be patiently waiting and see what has been happening here. So what I'm going to do right now is I'm going to put a gold poll. And I just want you to just let me know what you think here. Let's get some sentiment, guys. Let's get some sentiment according to your objective view, okay? I want to have your objective opinion. Don't listen to what I say. Just use this poll and let's see what we actually have in the chat. So as a group, okay, we can kind of get the understanding of what your guys' perception is. And then we can actually go from there, all right? All right, 63 votes. Ooh, it's so tricky. Damn, I didn't expect that. I didn't expect that. Wow, that's crazy. That is absolutely wild, actually. Wow. What? Let's see if we can get to like 150 votes, okay? If we can get to 150 votes, I think that's a good sample size. Damn, wow. We have 120 votes so far. 40% says up, 60% says down. That is really close, guys. That means that at least, I don't know, 50 of you guys said up and like 70 or 80% of you guys said down. 80, fuck, that's insane. There we go. Okay. Anyways, we have to mark out a couple of key levels here. Okay, the number one level that I'm marking out here on the weekly is already there. Okay, I just want to make sure that you guys understand this is on futures. Okay, and this is the 4825. Okay, the 4825 right there. All right, this is the weekly low, at least the open of the week of the 1st of February. Just want to make sure you guys understand this, because this is the monthly open of last week. It's the 4825. This should potentially act as a major area of support here. So I just want to make sure that you guys are aware of the 4825 on gold. And we're not that far away from that level here. So if you guys thinking about shorting below that, I think it's actually the best moment to buy, to be honest with you. Because even though you could say, oh, the gold is bearish, there are always bounces. There are always scenarios where we could potentially get into setups, okay? So the 4825 or the 4826 is a level I will be watching for that particular reason. Right now, you guys can clearly see that we're selling and that sellers are definitely in control here. So if you just open the order flow, I think it's pretty clear right now that sellers are absolutely in control here, okay? There we go. Let me look on the 50-minute here. A lot of sellers stepped into that area of resistance, which is this zone. You guys can see we're dealing with an overvaluation. Seller stepped in here. There's definitely a lot of selling pressure right now to most for gold here. So buying here is extremely, extremely tricky. Trader Academy says, yo, Lorenzo, long time no see. Why are you live so late right now? We are live because of the Fomc, my friend. We are live because of the Fomc. We're going to watch this very, very closely. Let me just open this up. Let me actually see if I can get this here on the screen for you guys. There we go. Yes. AD Cordial says, yo, my man, are you back on streaming on a daily basis? I am fully back, my friend. Absolutely. I am all in here. Yes, sir. Aeon says, yo, as I said yesterday, that higher time frame price action is bearish and price will revisit the Monday lows. That's what happened. I took short position and still holding. I think you made the right decision, my friend. I think you did make the right decision. Price absolutely tanked. In that range, though, it was still a good buy. A short-term scalp. Definitely. But yeah, the price action is for sure bearish right now. That's for sure. Three minutes, man. Hopefully, we're going to get some good information today. I really look forward to see what we have. What will be the usual time for your stream? 8 a.m. EST, man. 8 a.m. EST. Or actually, let's say 7:45. 50 minutes before the New York Open. Okay? In case you want to know what I'm doing here, I'm here back live again. Taking things back. I'm really been missing the live streams, as you guys know. So we have been streaming for the past week. Last week, we've been coming back to the streams again every day. You guys can see this right here. We have been definitely coming back to the streams here, which is amazing. And I'm really looking forward to see what we can do. Because, yeah, I need to trade the New York session anyways. So why not do it with you guys, right? Why not do it with you guys right here? Yes, sir. Hero Spot Bowman, my man. Good to see you back. Amazing to have you back, man. Hope you're doing well, my friend. All right, let's see what it has to say. Yes. Let's get the party started. Uncle Jerome, baby, give me what you give me everything. Come on.
The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East.
Yes.
Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December.
Yes.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years?
Listen, guys, just so I understand, he's my uncle, right? I know exactly what he wants. We all expected this stuff, okay? We're just going to go a bit deeper now, okay? Just so you know.
Now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time, and that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do, but essentially it is that the forecast is that we'll be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that, and the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or
Good
something
question.
else?
Good question.
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on
No bullish
core
signals for
goods.
gold.
and on tariffs and on the rest of it. You know, so for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, you know, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts?
This is something important to cover here, right? Right now, he's saying literally, do you think that the rate cuts are going to be temporary, or do you not see any rate hikes because of the fact that you think that oil prices are not going to continue to go up forever because of the war? It's a great question.
So the thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. You know, to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, you know, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP,
Frank, good to see you, my friend.
Because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. So, you know, we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And you also, you know, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, you know, the labor market is, the unemployment rate, of course, is little changed since September.
Yes.
You have a very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing, you know, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
He's not confident, guys. He is not confident, okay? He is not confident. I haven't seen it before like this.
Sure. In the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, you know, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah.
About
so there'll be an offset.
Offsets, yeah.
So that's true. You know, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, you know, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that
Huge
happening.
Close for the dollar. Huge close for the dollar.
Happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Okay, this is bullish.
Nick.
I got bullish for the dollar.
Nick Timoros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that
at this current moment, I really think about putting a sell limit on gold here, because I don't see any positive signs for gold, where the dollar will be supposed to be weaker. Everything that he says is about getting inflation down to 2%, no matter it takes. With the oil prices rising here, he's very uncertain. He doesn't sound really confident about what's going to happen here. I think this is not per definition bullish for gold right now.
A big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive, because of the weakness in the downside risk in the labor market. We are balancing these two goals
Latrice, welcome,
in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued. What we want to see for this year, rather, is continued progress on housing services. Finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course.
I don't see any bullish signals right now. Dollar is strong, dollar close above the highs right here. Clearly, gold is weak. Anything that he says is not considered to be bullish for gold. It's more considered to be bullish for the dollar right now. We're overvalued. We are seeing a major push down. This is the value low of this overall range. That means that from here, all right, we have seen that there is just not much buying taking place right now. And if you look at the order flow right here at the moment, you can see that sellers are clearly in control. I don't see any strong buyers stepping in yet.
Of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed.
Yes.
That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation.
No need to buy here. In my opinion, no need to buy gold here. That's my personal opinion.
On the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that.
Just a quick breakdown from the order flow perspective, okay? Because I think that you guys deserve to know this right now. If you look at the order flow right now, you can see there are a lot of buyers stepping in, yet price is not moving higher. You have to really ask yourself the question, why are buyers stepping in and price is not moving higher at this current moment here? Sellers are in control, okay? Sellers are in control. Either price is going to dump further right now, or we are actually going to see some pullback for a larger continuation down, but I don't see the larger absorption taking place, which is needed for price to actually reverse for a larger pullback. That's my personal opinion. Do whatever you want with this information.
Where there was a focus on the growth risks is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think
Music Roll, good to see you.
On the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs.
Good to see you.
Good to
see you.
Welcome, dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So you know, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and you know, are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration.
Yes,
that's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's
just for clarification, 42% of you guys before the actual session said, I think is gold going up, right? 42%. That's very, very, very 50-50. Very close here. But clearly, according to the actual order flow right now, and what we're currently seeing is that sellers are in control, and there is nothing that Jerome Powell said that seemed to be bullish for gold right here. We have to be very careful with long gold here. I love to buy the bottom. So don't get me wrong. I love to buy the bottom. But there's nothing that he says in combination with what we're seeing here that speaks any form of bullish indication.
Experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure, and it's just a very different thing and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? this energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Fuck it, we'll wait for better.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but
no bars.
There are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
It's a very unfortunate situation that he doesn't give any clarity about the conclusion if the oil price would go up further, if you would take any measurements against that. There's clearly a very neutral stance from his perspective of, like, if the oil price continues to rise because the Iran war, whatever the case may be, there's no clear stance in how would he approach it. If you would say consistently, if oil price would go up and the dollar would go up, we would potentially have to take some measurements to fight inflation. He's not stating this either here. So, for that reason, I think right now we might find a neutral stance for this actual meeting.
Maria Luisa.
Afternoon, Chair
Clearly
Powell,
buyers
Maria
not ready to
Luisa
step in
Capurro
here.
with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So At this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and that's.
So my personal opinion right now, guys, to be really honest with you, if I look at the gold right now, and I see how he started off this overall industry, this overall speech, right? He was very secure about what's happening with oil, about the oil prices and everything, and how this could impact inflation. So he definitely acknowledged that if oil goes up, inflation goes up. But now he's kind of like balancing things out, like, I don't know, the situation. And this is a typical, and I really want you to understand this, this is a typical Jerome Powell script, okay? This is exactly what he does. He starts off high, he moves down low, and he ends up somewhere in the middle, okay? So if you look at the price action right now on gold too, you can see the exact same thing happening. We opened up bearish, we're finding support. I would not be surprised if we would end up somewhere in the middle as well here until the speech is over. But it's still important to know, and we have to every time listen to what he says, because he could say one thing, one nuance, and boom, everything changes here. It's very important to pay attention to
stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course,
Capella, my man, good to see you.
People are already
Welcome.
seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
Good question.
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve?
She's
or
good.
Even if things
She's
remain
good.
as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So, the U.S. economy
thank you, Jeez. I appreciate
really
you guys.
been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is.
So just to clarify, that this is exactly where gold will pull back, right? He starts off high, very strong conviction, and then he moves his script. He replaces his opinion, and he starts to say things like, I don't know, I'm neutral, I'm not really know, we have to wait for the next event, blah, 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 right? This is why gold is reacting, right? At support right now, but it's very hard to trade these market conditions. I can't wait for gold to have that normal price action again. We're going to wait and see here, but this statement is extremely important for us to understand what the actual understanding is from the Federal Reserve right now.
Is, ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. And So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real...
The dollar is still very, very strong. Look at the dollar continue to push up here. The fact that gold is holding here shows there is definitely some buyers stepping in right now. The dollar is still holding up very well.
History, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change.
Ashish, welcome, my friend. Good to see you.
Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is,
So this is my current conclusion around gold. Okay, I'm gonna start putting on some music soon after this meeting. We're gonna go deep into gold again, but I don't see any strong bullish signals for gold that gives me a reason to buy. There are multiple levels here which I was interested in buying. But according to what I'm seeing right now, looking at the order flow, looking at all the things combined here, look at the dollar breaking out higher, closing above that major resistance, I don't see any reason to buy gold. I prefer to sell gold at higher levels. So I'm looking at the 4884, I'm looking at the 4894 to see if I could potentially get the sells. This is my current opinion right now. But let's see if he has anything more interesting to say. Let's see what happens.
Big price increases. All around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic. And everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet. And it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed. And, there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to the price, into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates?
Good question. Let's go.
And then secondly, diesel prices are rising faster than gas prices. How concerned are you
One
that
more
the
time.
increase
Rate has been little changed in recent months.
Listen to this question very well. This is an important question. How far does oil price have to go up in order for us to rate interest rates? This is a good question, because if we increase interest rates, this will increase the strength of the dollar. This will be bearish for the metal sector by default.
And inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate. In our summary of economic projections, the median participant thing, right? This energy supply shock.
gas prices, how concerned are you that the increase in diesel might drive up high wood oil prices and broader inflation?
Here we go.
Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates?
Good question.
And then secondly, diesel prices are rising faster than gas prices.
We'll get back to the root
How
time.
concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on
man,
it
good to see you, man. Have a blessed freaking day, man.
More
Good to
general
see you on the
concern
street.
than that. It's diesel prices, because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real, and they're material. So we are aware of that, and we're watching it. But you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Let's see what he says right now. But even though, again, very, very, very neutral, but we all know it's super important.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
No reason to buy gold.
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the
Priya, good to see you, my
current
friend.
situation lasts.
Welcome.
And then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that.
All right, so the conclusion, guys, I think this is the end of the press conference right here, as you guys can see already, right? This is just a replay right now, but there are definitely some clear indications. Let me put on some music here. Yes. Let me put a nice song, actually. Let me do this for you. All right. First of all, welcome back, anyone that joined the live stream today for the FOMC special. It's really good to have you here. No clear indications from Uncle Jerome. He is a master script writer. It's unbelievable. But we have music. Let's talk about it. Let's recap. Obscure and welcome to the stream, G. I can't wait for the regular trading sessions where we just have nothing to do with, no trading, no streams, no crazy news or whatever the case may be. Next week will be a normal trading week. But this is very important information. Let me recap pretty much what he said here so you guys have a full understanding of what is actually going on here, because this is for us extremely important information to always take consideration. No matter if you are a day trader, a scalper, a swing trader, I don't care what you trade, where you're from, how you perceive the market. There is one thing that we need to know, and that is what Uncle Jerome, aka Jerome Powell, says. All right, my uncle right here is never wrong about his bias. He's the ultimate script writer, as you guys already know. Okay, the ultimate, and when I say the ultimate, he is the master script writer when it comes down to starting off and knowing exactly what he is going to say about the inflation, the oil prices, the gold price, the dollar, whatever the case may be. He is fully aware of what's going on here. And so we need to know exactly what he's going. So we're going to decode the matrix. We're going to talk about what he said. And the conclusion is that he started off very strong. We need to protect inflation. We need to make sure that the inflation stays low. We need to do whatever it takes, which is obviously strong for the dollar. And then he started to slow down, and then he started to say, I don't know, I'm not really 100% certain about the situation right now with the war, blah, blah, blah. And then he finds some sort of middle ground, okay? This is what he does all the time. Have you ever Have you ever followed an FOMC meeting before? Type in a yes in the chat if you have ever watched a FOMC meeting before. So you know I'm not talking nonsense right here, right? This is his script. This is his standard. This is what he does, okay? And every single time when we trade live, when we want to take a trade, and we look at Uncle Jerome, we think, oh, he's might gonna tell us something. But every time, he gives us the same freaking answer. Every single time. Okay? Just so I understand. So how do we deal with this? We make sure that we follow our rules, our playbook, and we follow the right levels here. Did I expect the gold to drop a little bit? Yes, I did. Right? Was there a chance that gold might pull back right now, post like in the midterm of the speech? Yes, I did. I did expect some sort of pullback here. Right? Are we still freaking in the middle right now? We are in the middle right now, okay? So the conclusion is he's just following his script. We need to just wait, make sure that the gold balances out, finds its equilibrium, and then we can finally get back to work again and we can finally start trading gold normally. This to me is like a Chinese, a Chinese sculpture. All right, it goes from all angles. It's very, very hard to predict what's going to happen here. But there was one thing that I could definitely see from this exact stream, and that the buyers definitely got trapped. Buyers had no chance of following through here whatsoever, okay? So there was no chance of buying gold. I would never buy here for whatever reason, even if the dollar is strong. I would never buy gold at this current moment. So if people are starting to say, I think it's a buy, I think right now, for buys, you have to be very, 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 very careful. Okay? It's either selling or it's nothing, in my opinion. Okay? But that's just my personal opinion right now. I would never buy here. I would just look for sells only when it makes sense. Okay? That's kind of the overall idea here. Yo, is it AI, Lorenzo? No, this is actually me with Joe and Powell. We've been hanging out right here. I have my butterscotch cookies. I have my caviar. And we were actually reading the LTA trading war map together. And I told him this is the best strategy that ever existed. I talked about the volume profile, talked about you guys, the community, and how we are actually crushing it. And he's like, wow, yeah, that's kind of impressive. And I kind of made that statement very, very clear. Then I will pay a lot of attention to the streams and make sure that I inform you guys with the real information. So obviously, that's what we have been doing here today. Once again at 3 a.m. in the morning. 3:30 to be exact. Okay. Anyways, what is going to happen right now? You guys might ask, what will happen to gold? Well, the dollar is slowing down a little bit. Okay. The dollar is slowing down. Why is the dollar slowing down? Well, the dollar is overvalued against the euro. So usually when the dollar is overvalued against the euro, as you guys can see right here, we do see some sort of pullback. Right here, we were overvalued against the euro. We did see some sort of pullback. Right now, we're overvalued, so we do see some sort of pullback. So there is a chance that gold also might give us a little bit of a pullback. So I'm going to stick with my sell limit right now. I'm not going to change it. I'm going to stick with it at 4883. My stops are going to be above the highs, and I'm going to target these weekly levels right here. That's what I'm going to look at. This is the swing value area low. Fabio will be proud of me. When taking the swing high to swing low right here, looking for this value area low and looking for a potential short from that level, okay? Pullback short, execution at my limit order, 4883, stop loss 4907, target 4827, okay? This is my current bias around gold here. I don't see any buyers stepping in here. I don't see any reason to buy at this current moment. I do really hope to pull back and give you guys a more interactive live stream where we actually can execute live on stream. But again, do take consideration that it's the FOMC here and we're not here to gamble. We're here to actually make some money with high conviction, okay? That is the reason why we're here. But I hope you guys at least understand the overall perception of what Jerome Powell is doing here and why it is so important to pay attention to these streams and why not just neglect anything that the Federal Reserve says, because one thing, okay? Jerome Powell can say one thing and everything can change. And this is unfortunately how it is. So we're kind of glued to the screen. And we have to listen to a bunch of people talking a bunch of random stuff that we actually don't really care about, to be really honest with you. But we kind of have to follow it because we kind of understand that anything can happen in this game. And whatever he says is important. So if it's important, we have to listen to this. And I hope you understand the nuances, because this is where you learn actually what the interest rates do with the dollar and also what they could do with gold as well. So if you are a fanatic gold trader, you understand this is very important here. All right? Lorenzo, will you be able to integrate some order flow technique into your trading warm-up in the future? We will definitely come up with some order flow as well here. I'm still learning, my friend, so I'm not going to be here and pretending like I'm some sort of order flow guru. Okay, I am not. I'm just here to learn about the footprint chart. I'm getting better every day, and I'm definitely can tell you that I'm definitely learning a lot, and I'm just getting much better. My win rate has gone up so much since using order flow as well here. So I have to be honest, it's definitely helping, but I'm nowhere near an order flow trading guru, okay? I'm not gonna sell you some order flow course because I'm not gonna sell you something of which I'm not an expert at, all right? I just wanna be transparent here. James says liquidity sweep at 4830, then buy the top liquidity sweep at 4830, then buy the top till. Oh, that's exactly what you said. 4830, then buy. I don't know what you say, bro. Sorry. But I'm going to keep my sell limit open there. That's what I'm going to do. Okay? Just so you know. Lorenzo, I'm like a zombie right now. It's 3:33 a.m. in Lombok. That's where I live, very close by. It's 3:30 right now for me as well, my friend. So we're on the same page. Okay. Sometimes you have to do whatever you have to do for the streams, for the guys here, all right? I'm here to give you some free education. I'm here to trade. I'm here to learn. And that's why I'm here for you guys. So if you guys support me in any way, shape, or form here, you don't have to pay me anything. You don't have to sign up for anything. If you guys support the channel, just like this video, like the stream. And once we are back to a full trading week, we will be actually able to execute some freaking trades live, because of the non-news streams here. I think that's the best deal. Last week, we took around 5 trades. This week, we're a bit more hesitant because of the FOMC and etc. But I do have a limit order at 4883. Just so you guys know. I'm going to stick with this freaking limit order right there. Yeah. God's favorite, my man. As always, supporting the channel here. You better be streaming tomorrow. You're going to miss out on a nice move. I agree. Menzer. What's happening, G? Welcome to the stream. Hope you have a blessed day. And if you guys don't know who I am, I will be here streaming 5 days a week for the next coming months. 5 days a week, 8 a.m. EST, I will be here, okay? We are pulling back, and I told you guys very clearly here. Look at the dollar right now. Where am I here? Look at the dollar right now. What we just talked about, the dollar is overvalued against the euro, okay? The euro. Let me just put it in one more time. Let's put in the Euro USD. Right there. Boom. We are overvalued against euro. Whenever we're overvalued against the euro, we tend to push down. Okay, we tend to drop. This is why I believe that the sell limit is super relevant. Okay, I'm not gonna buy here. I'm not gonna predict the bottom in an uncertain scenario for gold. That's not aligned with my bias or my daily bias. But I am willing to sell if we come up higher and we potentially push back a little bit more, okay? This is the reason why I have a sell limit placed at 4883 on futures, just so you guys understand this, okay? But I did expect the dollar to drop a little bit because it has been dropping every single time when we're overvalued. And if you don't believe me, let me just quickly show you. You actually understand what I mean, what I'm talking about here, because so you understand I'm not talking nonsense, okay? Dollar. Let's go to the dollar. Let's go to the valuation on the dollar so you understand what I mean here. Okay? There we go. Dollar. Overvalued. We pull back. Overvalued. We pull back. Overvalued. We pull back. Overvalued. We pull back. All right? Overvalued. We pull back. Do you see the point? Overvalued. We pull back. We trust the valuation index, okay? We trust how we're valued against the euro when it comes down to the dollar. Well, at the dollar or gold, we look at the dollar. Now we guys understand this here, okay? We never buy. And we made this mistake before. We don't buy when we're overvalued, and we don't sell when we're undervalued. All right? That's for sure. That's for sure. All right, let me look at the chat real quick here. Let me see what you guys have been saying. And let me put on a nice tune for you. To show you that I love you, that I care about you, that I want you to become a good trader, a profitable trader, that I'm here for you, only for you, around this time here. I'm going to stick to this limit order, guys, and I'm going to see you guys tomorrow again. Nothing I can add on to this. It's very clear what Jerome Powell did today. It's the straight line persuasion. Okay? The straight line persuasion. Look it up on YouTube. Straight line persuasion. You understand what I mean here. Okay? Who's going to be tomorrow at the stream, 8 a.m. EST? We have no news to deal with, if I'm correct. Let me confirm this. Besides the unemployment claims. Nothing. Initial job claim, that's it. Nothing crazy. Let's actually trade gold normally tomorrow. No news, no crazy shit. Let's make it happen, man. I keep my limit order open. Lorenzo, I'm from Bali. Salam Malam, G. Salam Malam. Good to see you. Much love, guys. Looking forward to see you tomorrow. And I hope you learned something today from Jerome Powell, my uncle. Okay? Never disappoints. We look kind of similar, right? Right? We look kind of similar. That's what I thought. Take care, G's. Limit order at 4883, stop loss 4907, target 4827. And tomorrow we'll go back to the normal trading again, without the news, with all that additional stuff. Straight up price action. I'm looking forward to this. Okay? Thank you, guys. Smash that like button. That's how you support me. And thank you for the support. Love you all. Peace up. I wish you a blessed day. Take care of your family. Much love. Ciao.